Welcome back to Bookmint, the podcast where we unlock profound insights from the world's most transformative books. I'm your host, and today we're embarking on an intellectual journey that will challenge your fundamental understanding of money, economics, and history. Saifedean Ammous' seminal work, The Bitcoin Standard, The Decentralized Alternative to Central Banking, first edition. Before we delve into this monumental analysis, if you appreciate our commitment to bringing you these deep dives, please hit that like button, share this episode with anyone ready to question the monetary status quo, and subscribe to Bookmint. Your engagement fuels our mission. Saifedean Ammous is an economist who has garnered both acclaim and controversy for his uncompromising stance on sound money and his articulate critique of modern central banking. In The Bitcoin Standard, he doesn't just explain Bitcoin, he positions it within a grand historical narrative of monetary evolution, demonstrating why it is not merely a digital curiosity, but a crucial and perhaps inevitable antidote to the economic instability and societal ills fostered by fiat currencies and central bank control. Ammous takes us from the earliest forms of exchange to the gold standard, through its collapse and into the era of pervasive fiat money, meticulously highlighting the consequences of easy money versus hard money. He argues that Bitcoin, with its unalterable, scarce, and decentralized nature, offers a return to the principles of sound money that underpin prosperous civilizations, offering true individual freedom and a path to a more sustainable future. So, prepare for a deep and rigorous exploration. This isn't just about understanding a digital currency. It's about understanding the very foundation of our economic lives.
Chapter 1. What is economics? In the opening chapter, Saifedean Ammous lays the philosophical and methodological groundwork for his entire argument by defining economics from a perspective that is both classical and highly relevant to his thesis on Bitcoin. He establishes a framework centered on human action, time preference, and the role of savings, setting the stage for why sound money is not merely a financial concept, but a fundamental pillar of civilization. Ammous begins by positioning economics not as a study of government policy or market interventions, but as the study of human action in the face of scarcity. He draws heavily from the Austrian school of economics, particularly Ludwig von Mises, emphasizing that all human action is purposeful, aimed at alleviating some felt uneasiness, and involves making choices under conditions where resources, including time, are limited. Key concepts introduced and explored include scarcity. This is the bedrock of economic thought. Resources are finite, while human wants are infinite. Economics is the study of how individuals and societies allocate these scarce resources. Ammous applies this to money, arguing that true money must itself be scarce. Time preference. This is a crucial concept for Ammous. Time preference refers to the preference for immediate satisfaction over future satisfaction. High time preference. An individual with a high time preference values present consumption much more than future consumption. They are less likely to save, invest, or plan for the long term. Ammous links high time preference to societal ills, impulsivity, and short-sightedness. Low time preference. An individual with a low time preference is willing to forego present consumption for greater future gains. They are prone to saving, investing, and planning for the long term. This is seen as a hallmark of civilization and capital accumulation. Ammous argues that the nature of money significantly influences a society's collective time preference. Savings and capital accumulation. Savings are portrayed as the foundation of civilization. By deferring consumption, low time preference, individuals accumulate capital, which can then be invested in tools, infrastructure, and education. This capital accumulation is what drives productivity, technological advancement, and improvements in living standards. Direct production, producing goods for immediate consumption. Indirect production, roundabout methods. Investing capital in tools and processes that allow for more efficient and abundant production in the future. Ammous champions indirect production as the key to human progress. The role of money. Money emerges as a tool to facilitate trade and overcome the limitations of barter. Its primary function is a medium of exchange, but crucially, it must also serve as a store of value and a unit of account. For money to function effectively as a store of value, it must retain its purchasing power over time, resisting depreciation. Hard money versus easy money. This distinction is central to the book. Hard money. Money that is difficult and costly to produce more of. Its supply is relatively inelastic. Ammous argues that hard money discourages high time preference because it encourages saving, as it holds its value, and thus fosters capital accumulation and long-term planning. Examples traditionally include gold. Easy money. Money that is easy and cheap to produce more of, leading to an elastic supply. Easy money encourages high time preference because it loses value over time, inflation, thus discouraging saving and long-term investment. Fiat currencies are the prime example. Ammous's argument in this chapter is that a society built on hard money will naturally foster low time preference, leading to more savings, greater capital accumulation, technological progress, and a more stable, prosperous civilization. Conversely, a society built on easy money will promote high time preference, leading to consumption over saving, debt, instability, and a decline in real living standards. This chapter is a profound setup, establishing that the choice of money is not just a technical or economic detail, but a fundamental determinant of human behavior and societal trajectory. It sets the stage for why Bitcoin, as the hardest money ever invented, is presented as a necessary standard for a flourishing future.
Chapter 2. Primitive Monies. In Chapter 2, Primitive Monies, Saifedean Ammous takes the reader on a captivating anthropological and historical journey, examining the evolution of money from its earliest forms in various human societies. His purpose is to identify the fundamental characteristics that have always made certain commodities superior as money, thereby establishing the timeless criteria by which any form of money, including Bitcoin, should be judged. This historical lens reveals that money is not an invention of government, but an emergent property of human trade. Ammous begins by highlighting the inherent inefficiencies of barter. For exchange to occur, there must be a double coincidence of wants. Both parties must simultaneously desire what the other possesses. This severely limits the scope and scale of trade. To overcome this, societies began to adopt mediums of exchange that were not necessarily desired for their intrinsic use, but because they were generally accepted in trade. He then explores a wide array of historical, primitive monies, discussing their strengths and weaknesses based on several critical monetary characteristics: salability across space, portability, how easily money can be transported over distances. Examples: salt, cattle, shells, stone wheels, rye stones of Yap. Rye stones. Ammous famously discusses the rye stones of Yap, enormous limestone discs used as money. While lacking in portability, they stayed in place. Their ownership was transferred and recorded communally. This illustrates the importance of public ledger and consensus, which prefigures the blockchain.
Salability across time, store of value, how well money retains its value over time without depreciating. This is largely determined by its hardness, how difficult it is to produce more of it. Examples: grain, perishable; cattle, die, require upkeep. Perishability: commodities like grain are poor stores of value due to spoilage. Cost of maintenance: livestock requires feeding and care, diminishing its value as a store over time. Salability across scale, divisibility and consumability: how easily money can be divided into smaller units for small transactions or accumulated for large ones, and whether it can be consumed or used up. Examples: large cattle, indivisible for small purchases; beads, less useful for large purchases. Ammous argues that as societies developed, the most successful monies were those that maximized these salability characteristics, especially salability across time, hardness. This is because a money that holds its value well encourages saving, low time preference, which is the foundation of capital accumulation and civilization. He provides a rigorous definition of hard money, a money whose supply is highly inelastic, meaning it is difficult to produce more of it. The existing stock of hard money is so large relative to any new production that any increase in supply has a negligible impact on its overall value. Conversely, easy money is that whose supply is elastic and easily increased. Easy money loses value over time, penalizing savers and encouraging high time preference. The chapter serves to highlight that money is not a government invention. It emerged organically. The quest for sound, hard money is an ancient and universal human endeavor. The characteristics of good money are timeless and objective. Gold and silver eventually triumphed over other primitive monies due to their superior hardness and other salability characteristics. By establishing these historical patterns and monetary properties, Ammous sets a clear benchmark for evaluating modern currencies, and crucially, for understanding why Bitcoin represents the pinnacle of sound money, embodying the desirable traits that humanity has sought in its monetary mediums for millennia.
Chapter 3: Monetary History. Chapter 3, Monetary History, is a critical juncture in Saifedean Ammous's argument, tracing the evolution of money from its primitive forms to the gold standard, its eventual collapse, and the rise of the modern fiat system. This historical narrative is not merely descriptive, it's a polemic, designed to demonstrate that departures from hard money principles have consistently led to economic instability, societal decline, and the erosion of individual liberty. Ammous picks up where primitive monies left off, explaining why gold and silver eventually became the dominant forms of money across most advanced civilizations. The rise of gold and silver. He attributes their success to their superior monetary characteristics. Extreme hardness. Both metals are scarce and difficult to mine, making their supply inelastic relative to existing stocks. Gold, in particular, has the highest stock-to-flow ratio of any commodity. Durability. They do not corrode or decay. Divisibility. Easily divisible into smaller units. Portability. High value-to-weight ratio. Fungibility. Each unit is identical. Verifiability. Relatively easy to authenticate. This combination made them excellent stores of value and mediums of exchange, fostering low time preference societies that saved and invested for the long term. The emergence of fractional reserve banking. Ammous meticulously describes how the practice of fractional reserve banking arose.
Goldsmiths, initially holding gold for safekeeping, realized they could lend out a portion of the deposits, issuing paper receipts, while keeping only a fraction of the gold in reserve. This was the genesis of creating money from nothing and the foundation of modern banking. While facilitating credit, it also introduced the risk of bank runs and inflationary pressures. The gold standard and its corruptions. He presents the gold standard as a historical peak of sound money. Under a true gold standard, national currencies were directly convertible to a fixed weight of gold. This imposed discipline on governments, limiting their ability to print money excessively, thus controlling inflation. World War I. Ammous argues the WW1 was the catalyst for the unraveling of the gold standard. To finance the massive war effort, belligerent nations suspended convertibility, printing vast amounts of fiat money. Interwar period. Attempts to return to gold often involved devaluing currencies, causing instability. Bretton Woods system post-WW2. This system pegged the US dollar to gold, $35 per ounce, and other world currencies to the dollar. It was a quasi-gold standard, placing the US dollar at the center of the global financial system. Ammous argues this was a critical step in granting the US unique seigniorage power. The end of sound money, 1971. The pivotal moment, according to Ammous, was August 15, 1971, when U.S. President Richard Nixon unilaterally ended the convertibility of the U.S. dollar to gold. This officially ushered in the era of pure fiat money, backed by nothing but government decree and public trust. Consequences. Without the discipline of gold, central banks gained unprecedented power to expand the money supply. Ammous links this directly to accelerated inflation. The purchasing power of fiat currencies has steadily declined since 1971. Increased debt. Governments could now finance spending by printing money or borrowing without real constraints. Boom-bust cycles. Central bank interest rate manipulation led to exaggerated economic cycles. Erosion of savings.
Chapter 4. Money and Time Preference. Chapter 4. Money and Time Preference is arguably the philosophical core of Saifedean Ammos's book. Here he deeply explores the profound and intricate relationship between the nature of a society's money and its collective time preference. Ammous argues that the type of money people use fundamentally shapes their economic decisions, cultural values, and the trajectory of their civilization. He reiterates his definition of time preference, the extent to which an individual values present satisfaction over future satisfaction. High time preference, prioritizing immediate gratification, short-term thinking, less saving, more debt, impulsivity. Low time preference, prioritizing future well-being, long-term planning, more saving, investment in capital goods, delayed gratification. Ammous then systematically links the characteristics of hard money versus easy money to the promotion of low or high time preference. Hard money fosters low time preference. Store of value. When money is hard, for example, gold, its supply is inelastic, meaning it retains its purchasing power over time. This incentivizes people to save it, knowing their wealth will not be debased. Capital accumulation. Saving leads to capital accumulation. Individuals and societies invest in roundabout methods of production, tools, education, infrastructure that yield greater returns in the future. Delayed gratification. The reward for delaying consumption is evident as wealth grows. Societal benefits. Ammous associates low time preference with technological advancement, investing in long-term R&D, fundamental science, cultural flourishing, building enduring art,
architecture, literature. Stronger family units, planning for future generations, investing in children's education. Peace and stability, less prone to short-sighted conflicts, more focus on long-term prosperity. Moral responsibility, taking accountability for future consequences. Easy money fosters high time preference. Loss of value, inflation. When money is easy, for example fiat currency, its supply is elastic and central banks can print more of it. This leads to inflation, which erodes the purchasing power of savings. Discourage saving. Why save money that will be worth less tomorrow? People are incentivized to spend immediately, get rid of it before it loses value, or invest in speculative short-term ventures. Increased debt. With a constantly expanding money supply, borrowing becomes cheap and abundant, encouraging debt over saving. Societal detriments. Ammous links high time preference, induced by easy money, to short-termism. Focus on quarterly earnings, immediate gratification, lack of long-term planning. Speculation. Gambling on quick returns rather than productive investment. Erosion of capital. Consumption of existing capital without adequate replacement. Degeneracy. Declining artistic standards, focus on ephemeral trends. War and conflict. Financing wars through money printing makes them easier to start and prolong, passing the cost on to future generations. Moral decay. Less accountability, more impulsivity. Ammous explicitly draws parallels between the historical periods of the gold standard and fiat money, arguing that the shift from hard money to easy money, especially after 1971, directly correlates with a societal shift towards higher time preference across almost every measurable aspect: personal savings rates, government debt, family structures, artistic output, and educational long-term goals. This chapter powerfully argues that the choice of money is not merely an economic decision, but a moral and civilizational one. By understanding how money shapes our time preference, Ammous builds a compelling case for why returning to a hard money standard, embodied by Bitcoin, is essential for reversing societal decay and fostering a more prosperous, sustainable, and responsible future.
Chapter 5. An Austrian Theory of Bitcoin. In Chapter 5, An Austrian Theory of Bitcoin, Saifedean Ammous explicitly connects Bitcoin to the principles of the Austrian School of Economics, particularly its emphasis on sound money, free markets, and individual action. This chapter provides a rigorous theoretical framework for understanding Bitcoin's unique properties and its role as a superior form of money, building directly on the concepts of scarcity, time preference, and monetary history. Ammous frames Bitcoin as the ultimate manifestation of Austrian monetary theory in the digital age. He argues that Bitcoin's design solves the problems of centralization, inflation, and manipulation that plagued even the historical gold standard when it was managed by governments. Key aspects of an Austrian theory of Bitcoin. Money as an emergent phenomenon. Consistent with Austrian thought, Ammous emphasizes that money is not an invention of the state, but emerges organically from the market's need to overcome the inefficiencies of barter. The most saleable commodity becomes money. Bitcoin, despite being designed, achieved its monetary status through voluntary market adoption. Hard money versus easy money revisited. This core Austrian distinction is central. Bitcoin, with its absolute fixed supply of 21 million units, is presented as the hardest money ever invented. Inelastic supply. Its supply schedule is immutable and cannot be altered by any central authority, making it impervious to inflation via quantitative easing. Stock-to-flow ratio. Ammous highlights Bitcoin's incredibly high and predictable stock-to-flow ratio, which is superior even to gold, indicating its extreme hardness. Decentralization and censorship resistance.
Austrian economists are inherently skeptical of centralized power, especially in monetary policy. Bitcoin's decentralized nature is its critical feature. No central authority. No government, corporation, or individual can control or stop Bitcoin. Censorship resistance. Transactions cannot be blocked or reversed by intermediaries, giving users true financial sovereignty. This aligns with the Austrian emphasis on individual liberty and property rights. Market efficiency and price discovery. Ammous discusses how Bitcoin's transparent and open ledger allows for efficient price discovery, unhindered by the hidden manipulations of central banks or opaque financial markets. Bitcoin and time preference. Building on Chapter 4, Ammous reinforces that Bitcoin's hardness naturally encourages low time preference. Incentive to save. Knowing that Bitcoin's purchasing power will likely increase, or at least not be debased, incentivizes individuals to save for the long term. Capital formation. This saving leads to increased capital formation, productive investment, and sustainable economic growth, rather than speculative bubbles fueled by easy credit. Against central banking and fiat money. The chapter is a direct indictment of central banking. Malinvestment. Central bank manipulation of interest rates, the price of money, distorts market signals, leading to malinvestment, misallocation of capital, and boom-bust cycles. Fiat money's flaws. Fiat money's elastic supply allows governments to finance wars and welfare states through inflation, silently taxing savers and transferring wealth. Bitcoin offers an escape from this system. The Bitcoin Standard. Ammous introduces the idea that a Bitcoin standard would bring back the monetary discipline that was lost with the gold standard, but in a more robust, decentralized, and censorship-resistant form. It would provide an objective measure of value and limit the power of states over their citizens' money. Technological superiority. While not exclusively an Austrian point, Ammous recognizes Bitcoin's technological innovations, blockchain, proof of work, as the means to achieve its unparalleled hardness and decentralization, qualities highly valued within the Austrian framework for sound money. In essence, Ammous argues that Bitcoin is not just compatible with Austrian economic thought, it is the practical embodiment of its core monetary principles for the digital age. It offers a market-based solution to the problems of central planning in money, providing individuals with a means to opt out of the fiat system and return to a foundation of hard, sound money that promotes savings, capital accumulation, and a low time preference society. This chapter solidifies Bitcoin's intellectual grounding within a respected school of economic thought.
Chapter 6. What is Bitcoin? Having laid the historical, economic, and philosophical groundwork, Saifedean Ammous dedicates Chapter 6, What is Bitcoin, to a focused and detailed explanation of Bitcoin itself. While avoiding overly technical jargon, he delves into the core components and properties that make Bitcoin the hardest money and the decentralized alternative to central banking that he advocates for. His goal is to make Bitcoin's fundamental nature understandable to a broad audience. Ammous begins by stating simply that Bitcoin is digital cash, scarce in supply, that exists without any central authority. It is a peer-to-peer electronic cash system. Key aspects of Bitcoin he elucidates. Digital scarcity, the 21 million limit. This is Bitcoin's defining feature. Ammous emphasizes that Bitcoin has an absolute, hard-coded supply cap of 21 million units. This scarcity is enforced by its protocol and cannot be changed without unanimous consent from the network, which is practically impossible. This makes it immune to the inflation and debasement that plague fiat currencies.
He contrasts this sharply with the infinitely elastic supply of central bank money. Decentralization. No central server authority. Bitcoin is not controlled by any single company, government, or individual. It operates on a global network of computers, nodes. Censorship resistance. Because there's no central point of control, no single entity can stop transactions, freeze accounts, or confiscate funds. This is crucial for financial sovereignty. Network resilience. Its distributed nature makes it incredibly robust and resistant to attack or shutdown. The blockchain, public ledger. Immutable record. The blockchain is a public, immutable, and append-only ledger that records every Bitcoin transaction ever made. Transparency. All transactions are visible to anyone, though identities are pseudonymous, linked to wallet addresses, not personal names. Trustless verification. Any participant can verify the entire history of transactions without needing to trust a third party. Mining and proof of work. Securing the network. Ammous explains that Bitcoin is secured by miners who use specialized computers to solve complex mathematical puzzles. Proof of work. Economic incentive. Miners are rewarded with newly minted Bitcoin, block rewards, and transaction fees for successfully adding new blocks of transactions to the blockchain. Immutability. The immense computational effort required makes it virtually impossible to reverse past transactions, as an attacker would need to redo all the work of subsequent blocks, which would require an economically prohibitive amount of energy. This is what provides Bitcoin's unparalleled security. Difficulty adjustment. He explains that the mining difficulty automatically adjusts roughly every 2 weeks to ensure that new blocks are found at a consistent rate, approximately every 10 minutes, regardless of how many miners are active. This maintains the predictable issuance schedule. Halving. Ammous revisits the halving mechanism, where the block reward is cut in half approximately every 4 years. This programmed reduction in new supply reinforces Bitcoin's scarcity and contributes to its deflationary nature over time. Private keys and public addresses. Self-custody. Private key. The secret code that proves ownership of your Bitcoin and allows you to spend it. Ammous stresses the crucial importance of not your keys, not your coins. Public address. A public identifier, like a bank account number, that you share to receive Bitcoin. Self-custody. The ability to hold your own private keys, giving you absolute control over your funds, free from intermediaries. Bitcoin as sound money. Ammous concludes by synthesizing these technical aspects into an economic argument. Bitcoin possesses all the essential qualities of sound money: scarcity, durability, divisibility, portability, fungibility, verifiability, to an extent superior to gold and certainly far superior to fiat currencies. It is the hardest money ever discovered, designed to resist debasement and foster low time preference. This chapter is a powerful yet digestible overview, solidifying the reader's understanding of Bitcoin's mechanics and economic properties. By detailing what Bitcoin is, Ammous reinforces why it is uniquely positioned as the decentralized alternative to central banking, offering a path to monetary freedom and economic stability.
Chapter 7. Storing and Trading Bitcoin. In Chapter 7, Storing and Trading Bitcoin, Saifedean Ammous transitions from the theoretical and technical to the intensely practical. He provides essential guidance on how individuals can safely acquire, store, and interact with Bitcoin, emphasizing the critical importance of self-custody for realizing Bitcoin's promise of financial sovereignty. Ammous begins by stressing that Bitcoin is fundamentally different from traditional assets held by intermediaries.
While convenience often draws people to third-party services, true ownership and security in Bitcoin lie in controlling one's private keys. The importance of self-custody, not your keys, not your coins. This is the core message of the chapter. Ammous warns against storing significant amounts of Bitcoin on exchanges or with third-party custodians, as this reintroduces the very risks, censorship, confiscation, insolvency, hacks that Bitcoin aims to solve. He explains that if a third party holds your private keys, they ultimately control your Bitcoin, not you. Bitcoin wallets. He clarifies that a wallet doesn't actually store Bitcoin. It stores the private keys that allow you to access and spend your Bitcoin on the blockchain. He categorizes and explains different types. Hardware wallets, cold storage. These are physical devices designed to store private keys offline. Ammous strongly recommends them for storing any significant amount of Bitcoin. Security. Immune to online hacks, malware. Transactions are signed on the device. Examples: Ledger, Trezor. Software wallets, hot wallets. Apps on smartphones or desktop computers. Convenience. Easy for small amounts. Everyday spending. Higher risk. Connected to the internet, more vulnerable to malware, phishing, device loss. Paper wallets, extreme cold storage. Printing private keys and public addresses on paper. While offline, they have usability and security challenges. Easily damaged, difficult to spend from. Ammous suggests hardware wallets are generally superior. Seed phrases, recovery phrase. Ammous emphasizes the critical role of the 12 or 24-word seed phrase generated by a hardware wallet. This phrase is the ultimate backup for your private keys. Security must be kept absolutely secure, offline, and never photographed, typed into a computer, or stored in the cloud. Storage. Write it down on paper or engrave it on metal, and keep multiple copies in separate, secure physical locations. Example: home safe, bank vault. Acquiring Bitcoin, exchanges. While advocating self-custody after purchase, Ammous explains that exchanges are necessary for converting fiat currency into Bitcoin. Reputable exchanges. Use well-established, regulated exchanges, examples: Coinbase, Kraken, Binance, that adhere to KYC, Know Your Customer, and AML. Withdraw immediately. His advice is to buy Bitcoin on an exchange and then immediately withdraw it to your personal hardware wallet. Trading and price volatility. Ammous acknowledges Bitcoin's price volatility, but emphasizes that its long-term trend has been upwards. He discourages day trading for most individuals, aligning with his low time preference philosophy. Bitcoin is primarily a long-term store of value, not a speculative instrument. Security best practices. Strong passwords and 2FA for any online accounts, exchanges, hot wallets. Beware of scams, phishing, fake websites, fraudulent investment schemes. Verify addresses. Always double-check Bitcoin addresses when sending or receiving. Start small. Begin with small amounts to learn the process before committing significant capital. Education. Continuous learning about Bitcoin security is paramount. Ammous concludes that taking responsibility for one's own Bitcoin security is a crucial step towards true financial freedom. While it requires diligence, the ability to be your own bank, free from the risks and control of third parties, is the ultimate promise of the Bitcoin standard. This chapter serves as an indispensable practical guide for anyone looking to enter the world of Bitcoin safely and sovereignly.
Chapter 8: Altcoins and the Difficulty of Sound Money.
In Chapter 8, Altcoins and the Difficulty of Sound Money, Saifedean Ammous turns his critical gaze toward the vast and ever-growing landscape of altcoins, alternative cryptocurrencies to Bitcoin. He argues that while many altcoins promise innovation and superior features, they overwhelmingly fail to meet the stringent criteria of sound money that Bitcoin uniquely embodies. This chapter reinforces Bitcoin's singular position as the hardest money, highlighting the inherent challenges in creating a truly decentralized and unalterable monetary asset. Ammous begins by acknowledging the sheer number and diversity of altcoins, often launched with claims of being better, faster, or cheaper than Bitcoin. However, he systematically dissects why almost all of them fall short in crucial areas, particularly in achieving monetary hardness and decentralization. The easy money problem of altcoins. Inflationary supply. Many altcoins have elastic, unlimited, or easily changeable supplies, making them easy money. Their developers or founding teams often retain significant control over the supply, making them susceptible to inflation and debasement, similar to fiat currencies. Lack of credible scarcity. Even if a limited supply is initially programmed, the ease with which new altcoins can be created, or the existing ones modified, undermines their credible scarcity. The fork of an altcoin into another, or the creation of a better version, essentially increases the overall supply of similar digital assets. The centralization trap. This is a major point for Ammous. Most altcoins, by their nature, exhibit significant degrees of centralization. Founding teams or developers. Many altcoins have identifiable founders or small groups of developers who retain substantial influence over the protocol's direction, updates, and even the initial distribution of coins. This introduces a single point of failure and makes them susceptible to pressure, capture, or internal disagreement. Consensus mechanism. Many use different consensus mechanisms than Bitcoin's proof of work, e.g. proof of stake. Ammous argues that these often lead to further centralization, as large holders, stakeholders, gain disproportionate influence, making them more like traditional corporations than truly decentralized networks. Premines and ICOs. Many altcoins begin with premines, where the founders allocate a large portion of the supply to themselves, or ICOs, which centralize ownership and control from the outset. The fixer-upper fallacy. Ammous criticizes the idea that altcoins can simply fix Bitcoin's perceived flaws, e.g. speed or transaction fees. He argues that Bitcoin's perceived slowness on the base layer is a feature, not a bug, ensuring unparalleled security and immutability. Attempts to optimize for speed or low fees often come at the expense of decentralization and security, which are the fundamental properties of sound money. He emphasizes the layered approach, like the Lightning Network, as Bitcoin's true scalability solution. Network effect and Lindy effect. Network effect. Bitcoin has the largest, most secure, and most decentralized network. This network effect is incredibly difficult for altcoins to replicate, as money's value is derived from its widespread acceptance. Lindy effect. Ammous implicitly references the Lindy effect, suggesting that the longer Bitcoin has survived, the greater its future life expectancy. Altcoins, being newer and unproven, lack this historical resilience. The cost of decentralization and hardness. He explains that achieving true decentralization and hardness is incredibly difficult and expensive. Bitcoin's proof of work consumes enormous energy, which is the necessary cost of its security and inalterability. Altcoins that promise free or cheap transactions often do so by compromising on these essential monetary characteristics. Ammous concludes that while altcoins may offer intriguing technological features or serve as platforms for decentralized applications, they fundamentally fail as superior forms of sound money. Their ease of creation, inherent centralization, and lack of credible scarcity make them closer to easy money or even digital securities than to a truly decentralized, hard monetary standard. This chapter solidifies Bitcoin's unique and enduring position at the top of the monetary hierarchy, reinforcing his central thesis that it is the only viable alternative to central banking.
Chapter 9. Bitcoin and Freedom. In Chapter 9, Bitcoin and Freedom, Saifedean Ammous elevates the discussion beyond economics and technology, framing Bitcoin as a potent tool for individual liberty and human freedom. He argues that the control of money is fundamentally intertwined with state power.
And by providing a decentralized alternative, Bitcoin offers a crucial means for individuals to reclaim sovereignty over their finances and, by extension, their lives. Ammous begins by asserting that central banking and fiat money are inherently instruments of control. Governments, by controlling the money supply and payment systems, gain immense power. Taxation through inflation. Debasing currency is a hidden tax on everyone's savings. Censorship of transactions. Governments and financial institutions can freeze accounts, block payments, or impose capital controls. Financing of war and expansion. Easy money allows governments to finance wars and expand their power without immediately facing the fiscal consequences, passing the cost on to future generations through inflation. Bitcoin, Ammous argues, fundamentally challenges this paradigm by offering an opt-out mechanism from the centralized fiat system. Financial sovereignty and censorship resistance. This is a cornerstone of Bitcoin's link to freedom. Permissionless. Anyone, anywhere, can send or receive Bitcoin without needing permission from a bank or government. Unconfiscatable with self-custody. If an individual holds their private keys, their Bitcoin cannot be easily seized or frozen by authorities, unlike traditional bank accounts. Privacy, pseudonymity. While transparent, Bitcoin transactions are pseudonymous, offering a degree of privacy from state surveillance that traditional banking lacks. Protection against inflation and wealth confiscation. By providing a hard, scarce money, Bitcoin offers individuals a way to preserve their wealth from governmental debasement, inflation, and potential confiscation through capital controls or excessive taxation. This is particularly vital in authoritarian regimes or countries experiencing hyperinflation. Empowerment of the oppressed. Ammous highlights how Bitcoin serves as a lifeline for individuals living under oppressive regimes or in areas with broken financial systems. It allows them to bypass corrupt intermediaries, receive remittances, and store value outside the reach of tyrannical governments, thereby fostering greater individual autonomy and human rights. Decentralized resistance. Bitcoin's decentralized nature makes it incredibly resilient to state attempts at suppression. There is no central server to shut down, no CEO to arrest. A global ban is practically impossible, making it a powerful tool for decentralized resistance against financial authoritarianism. Economic freedom and global trade. Bitcoin facilitates truly free and open global trade, allowing individuals and businesses to transact without relying on costly, slow, and potentially politicized cross-border banking systems. This opens up economic opportunities for those historically excluded from global commerce. A check on government power. By offering an alternative, Bitcoin provides a market check on government monetary policy. If governments engage in excessive money printing or financial repression, citizens have a viable option to exit the fiat system, thereby potentially forcing governments to adopt more responsible fiscal and monetary policies. Low time preference and civilization. Connecting back to Chapter 4, Ammous reiterates that hard money, Bitcoin, fosters low time preference. This freedom from inflationary pressures allows individuals to plan for the long term, save, invest, and build a more prosperous and stable future free from the short-termism and debt-driven cycles promoted by easy money. Ammous concludes that Bitcoin represents a profound technological and economic innovation that returns monetary power to the individual. It is not merely a financial asset, but a declaration of independence from central control, offering a powerful avenue for preserving and expanding human freedom in an increasingly digital and surveilled world. For those who value liberty and self-sovereignty, Bitcoin is presented as an indispensable tool. Chapter 10: Bitcoin and Energy. In Chapter 10, Bitcoin and Energy, Saifedean Ammous tackles one of the most frequently debated and often misunderstood aspects of Bitcoin: its energy consumption. He confronts the common criticisms head-on, providing a detailed economic and environmental argument that not only defends Bitcoin's energy use, but also positions it as a potential catalyst for the growth of sustainable energy. Ammous begins by acknowledging that Bitcoin's proof-of-work mining process does consume a significant amount of electricity. However, he argues that simply focusing on the raw energy numbers without understanding the context, source, and value produced is a flawed approach. The purpose of energy consumption: security. Ammous clarifies that Bitcoin's energy consumption is not wasteful. It is the necessary cost of its security and decentralization. The computational effort, hashing, involved in proof of work makes it astronomically expensive to attack or alter the Bitcoin blockchain, thereby guaranteeing its immutability and censorship resistance. This energy is literally protecting trillions of dollars worth of value and the integrity of a global, neutral monetary system. He poses the question: what is the cost of securing a sound monetary network? Contextualizing energy use. He puts Bitcoin's energy consumption into perspective by comparing it to other industries and systems. Traditional banking system. The vast energy footprint of physical banks, ATMs, data centers, corporate travel, and currency production for fiat money is often ignored. Gold mining. The environmental impact of physical gold mining, heavy machinery, chemical waste, land degradation, human labor costs is far more substantial and destructive than digital Bitcoin mining. Other industries. Bitcoin's energy use pales in comparison to many other industries, e.g. residential air conditioning, always-on consumer electronics. He argues that society accepts high energy use for valuable services. Bitcoin should be no different if its value is recognized. Bitcoin as an energy buyer of last resort, monetizing stranded energy. This is a key argument. Bitcoin miners are unique in their ability to be geographically agnostic and to operate with high flexibility. They seek out the cheapest electricity, which is often excess, intermittent, or otherwise wasted energy. Flares gas. Natural gas often flared, burned off at oil wells due to lack of pipeline infrastructure, a major environmental pollutant. Bitcoin miners can capture and convert this waste energy into valuable Bitcoin. Hydroelectric power. In remote regions with abundant hydropower, excess electricity might be curtailed or unused. Bitcoin miners can provide a constant, profitable demand, making these renewable projects more viable. Intermittent renewables, solar and wind. Solar and wind power are intermittent sources. During peak production, they often generate more electricity than the grid can handle, leading to curtailment. Bitcoin miners can absorb this excess energy, turning what would otherwise be wasted into revenue, thereby making renewable energy projects more profitable and incentivizing further investment in them. Driving renewable energy innovation. Ammous contends that Bitcoin mining can act as a powerful economic catalyst for the development and deployment of renewable energy sources. By providing a flexible, always-on buyer of energy, it reduces the financial risk for renewable energy producers and helps stabilize grids struggling with intermittent supply. Efficiency improvements. He notes that Bitcoin mining hardware constantly becomes more energy efficient, meaning the network's overall carbon intensity per unit of security can decrease over time, even as its total energy consumption might grow with adoption. Ammous concludes that the narrative of Bitcoin as an environmental villain is often simplistic and misleading. Properly understood, Bitcoin's energy consumption is a feature, not a bug, central to its security model. Furthermore, its unique economic incentives can align with environmental goals, driving the utilization of wasted energy and accelerating the global transition to more sustainable power sources. Bitcoin's energy use is the price of its freedom and security, and it might paradoxically be one of the greenest financial technologies invented.
Chapter 11. The Future of Bitcoin. In the concluding Chapter 11, The Future of Bitcoin, Saifedean Ammous synthesizes his extensive arguments to project a compelling vision of a world increasingly shaped by the Bitcoin standard. He moves beyond prediction to argue for Bitcoin's eventual triumph not as a speculative asset, but as the foundational monetary layer for a more prosperous, free, and sustainable global civilization. Ammous begins by emphasizing that Bitcoin is still a very young technology, barely a decade old when the book was written. Its journey, much like the early internet, is just beginning, and its full implications are still unfolding. He cautions against linear thinking, suggesting that Bitcoin's impact will likely be far more profound and pervasive than current skeptics imagine. The inevitable move to a Bitcoin standard, hyper-Bitcoinization. Ammous argues for the concept of hyper-Bitcoinization, a spontaneous, market-driven process where Bitcoin eventually becomes the dominant, if not sole, global monetary standard. This happens because Bitcoin's superior monetary properties, absolute scarcity, decentralization, and censorship resistance, make it a fundamentally better store of value and medium of exchange than any fiat currency. As people realize fiat's inevitable debasement, they will continuously opt for harder money. Network effect. As more people adopt Bitcoin, its utility and value increase, incentivizing further adoption. Opt out. Individuals and institutions will increasingly opt out of the inflationary fiat system, accelerating its decline. Layers of innovation. He reiterates that Bitcoin's base layer, the blockchain, is optimized for security and immutability, not speed for microtransactions. The future will see the continued development and widespread adoption of second-layer solutions like the Lightning Network, which enable instant, low-cost micropayments, making Bitcoin perfectly suitable for everyday commerce globally without compromising the security of the base layer. Further layers will emerge, building a robust digital financial ecosystem. Restoring sound economics. A world on a Bitcoin standard, Ammous predicts, will inherently foster low time preference, as discussed in Chapter 4. This will lead to increased savings and capital accumulation, sustainable economic growth based on real savings and production rather than debt and central bank manipulation, reduced debt. Governments and individuals will face hard budget constraints, promoting fiscal responsibility. Ethical markets. Distortions caused by easy money, malinvestment, boom-bust cycles will diminish. Reclaiming individual freedom and sovereignty. Bitcoin offers individuals an unprecedented level of financial sovereignty. In the future, this will translate to greater freedom from state control, censorship, and inflation. People will truly own their wealth, protected from arbitrary confiscation or debasement. This will have profound implications for human rights and individual liberty globally. Geopolitical implications. Ammous foresees a shift in geopolitical power. Nations that embrace the Bitcoin standard will likely benefit from stable money and attract capital, while those clinging to fiat will struggle with economic instability. Bitcoin could foster a more multipolar world, reducing the hegemonic power of any single currency. Environmental alignment. As discussed in Chapter 10, Ammous envisions Bitcoin increasingly being powered by and in turn driving the development of renewable energy sources. Its unique properties will turn wasted energy into valuable assets, aligning economic incentives with environmental sustainability. Challenges and resistance. Ammous acknowledges that the transition will not be without challenges. Incumbent powers, central banks, governments, and traditional financial institutions will resist.
but he argues that the economic forces and Bitcoin's inherent resilience will ultimately make its widespread adoption unstoppable. Ammous concludes with a powerful and optimistic vision. Bitcoin is more than just a currency. It is a fundamental shift that promises to restore sanity to economics, return power to individuals, and lay the foundation for a more prosperous and free civilization. It represents a return to enduring principles of sound money, re-engineered for the digital age, and its future is not just bright, but a necessary evolution for humanity. The choice to adopt the Bitcoin standard is, for Ammous, a choice for a better future.
And that concludes our comprehensive exploration of Saifedean Ammous's groundbreaking work, The Bitcoin Standard, the Decentralized Alternative to Central Banking. What an intellectual marathon, forcing us to re-examine the very bedrock of our economic understanding. Ammous's arguments are not for the faint of heart, but they are meticulously researched and profoundly challenging, painting a compelling picture of Bitcoin as the hardest money ever created and a vital tool for individual freedom and economic stability. From the history of money to the intricacies of time preference, from the flaws of fiat to the robust design of Bitcoin, this book provides an indispensable framework for understanding the ongoing monetary revolution. It's a call to think critically, to understand the true nature of sound money, and to consider a decentralized alternative for a more sovereign future. If this deep dive has stimulated your mind and perhaps even shifted your perspective, please show your support by hitting that like button, sharing this episode with anyone you believe needs to hear this powerful message, and of course, subscribing to the Book Mint channel for more insightful journeys into the books that truly matter. Thank you for joining me on this profound discussion. Until next time, stay curious, stay informed, and ponder the implications of true hard money.